Hello to all my Joe dolls. If you're new to the channel, welcome. I make content on finance, real estate, and other life topics. Be sure to subscribe and hit the notification bell as I'm posting valuable new content on a weekly basis. Alright, so today I'm going to discuss a finance topic that I feel is just not discussed enough, especially for those of you who are in high school, maybe you just graduated from high school, or maybe you're just starting out on your college or career path, and that topic is what are credit cards and how do credit cards work? So how do credit cards work is such a common question asked by those who've never owned one. Now, if you're just now starting out on your credit journey, how you manage your credit card is a very important part to establishing good credit history and good credit card habits. I believe that knowledge is power, and the reality is that many people just do not understand how credit cards work, and this lack of information can lead you down a bad financial road early in life. Alright Joe dolls, so my goal in this video is just to provide an overall breakdown of how credit cards work. Alright, so prior to having your own credit card, it may have seemed like magic just to see another person swipe a piece of plastic and walk away with their purchase. No questions asked, no cash paid. You may have even thought to yourself, well, this is really freaking cool. It's free. I don't have to pay because no cash was exchanged. Now, you may have heard the expression, if it's too good to be true, it probably is. So don't be confused by that lack of cash being exchanged. Paying for items with the credit card does not mean that you get the items you're buying for free. Instead, you have to pay for them later. It's basically an IOU. So you're given a grace period, which is a certain amount of time, usually 2 to 3 weeks, to pay for your entire purchase in full, or you can end up actually paying more for it due to interest charges. Alright, so you still may be wondering, well, what is a credit card? So a credit card allows you to access the credit limit that's provided by your credit card issuer, the bank. And a credit limit acts like a loan. So some credit card issuers are US Bank, Bank of America, Chase, and Wells Fargo, just to name a few. So with the credit card, you do not get a full loan in cash. Instead, the bank lets you take as much of the credit limit as you want at a given time, and then allows you to reuse the credit limit over and over, just as long as you pay back what you've borrowed. Now, your credit limit is dependent on many factors such as your income, your credit score, and your credit history. So for example, if you were approved for a $1,000 credit limit, this would represent the maximum amount you are able to charge in purchases. So let's discuss how credit cards work. So you swipe your piece of plastic, and that's pretty much it, guys. You're done. Take your stuff and hit it as fast as you can. Nah, I'm kidding. But there is a lot that goes behind the scenes that you just don't see. By the way, if you guys are enjoying the content so far, please do me a favor and hit that like button. It really helps me out a ton. So Joe dolls, after you swipe your credit card to make a purchase, the merchant's credit card terminal asks your credit card issuer whether your card is valid, and it also asks if you have enough available credit. Your credit card issuer then sends a message back stating that the transaction is approved or declined. If it's approved, you can take your goods and services and go on your way. If not, it could be that your credit limit is maxed out, meaning you don't have enough credit to cover your purchase. So if you had a credit card with a $1,000 limit, and let's say your balance was $950, meaning that this is the amount that's owed, and let's say you went shopping and want to make a $100 purchase. Well, in this case, it could decline because that would put your credit card balance at $1,050 and you only have a $1,000 credit limit. So the amount you owe compared to your credit limit is referred to as your utilization rate. Now, in order to keep your credit score in the best possible condition, it's recommended to keep your utilization rate under 30%. So using that prior example, if you had a $1,000 credit limit, you'd want to make sure that you do not spend or charge more than $300, which would represent a 30% utilization. So Joe dolls, each time you make a purchase, your available credit goes down by that same amount. Let me give you another example. If you had a $100 credit limit, and let's say you make a $25 purchase, that means you have $75 in available credit remaining. So you would owe $25 to the bank. Now, if you borrow another $50 before paying back that initial $25 you borrowed, you would now owe the bank a total of $75 and have $25 left in available credit. Now you can repeat this process over and over, spending up to your credit limit and repaying the balance as many times as you like, as long as you remain in good standing with the terms of your credit card. Now, some of these credit card terms could include making your payments on time and not charging more than your available credit limit. So as long as you keep your card in good standing, you can continue borrowing against your credit limit over time, which is why credit cards are referred to as revolving accounts or open-ended accounts. So there are things to be mindful when using credit cards. There can be costs. So the credit card issuer gives you a certain amount of time to pay back the entire amount that you've borrowed before you charge interest. So this period of time before the interest is charged is called the grace period, which is typically between 21 and 25 days if you don't pay your full balance before the end of the grace period. A finance fee or charge is added to the balance. Now the finance charge is based on the interest rate and your remaining balance on the card when your statement period is closed. So the interest rate, the annual rate you pay for borrowing money on your credit card. Remember guys, it's an IOU. Interest rates are generally based on market interest rates, your credit history, and the type of credit card you own. So if you have a good history of paying back your credit card bills and a good credit history, you can usually qualify for lower interest rates. Just remember, Joe Dolls, you have to pay your balance in full before the end of the grace period if you want to avoid paying interest charges. Alright guys, so I mentioned earlier a statement billing period, so let me explain that a bit further. Each month, the credit card issuer will send you a billing statement, which will include your minimum payment that's due, your due date, and a list of charges or transactions that have posted to your account since your last billing period. So it's always a good idea to review these transactions to make sure that all of the transactions were made by you and that there are no errors. You also want to make sure that your last payment was applied to your account correctly, and if there are any fees that have been added to your balance, you just want to make sure that they're accurate. So Joe Dolls, there you have it. What is a credit card and how credit cards work? So what are you guys' thoughts about credit cards? I would love your feedback in the comments section. Now if you found value in the video, please hit that like button and share this video with others on all your social media platforms, as it really does help to support and grow the channel. Thank you for watching, and until next time.